Hello students, welcome back to Accounting 2401, Principles of Financial Accounting. This is your instructor, Dr. Mercado speaking, and I hope all of you are having a wonderful week, okay? We are continuing covering Chapter 4, which deals with the accounting cycle. Now, in this lecture, we're going to be covering specifically problem 4-2A, okay? It is a long problem. I am warning you, but nothing to be afraid of. We've already covered preparation of financial statements before. We are just going to get more practice. So by now you should be familiar. Now your textbook does a fantastic job in providing you examples step by step of how to prepare your financial statements. All we have to do is invest a little bit of time to review that information, and voila, we should be good to go. Okay. Now before we begin, I want to provide a general overview. In this particular lecture, the problem is based on preparing your financial statements, the basic financial statements, which are your income statement, your statement of stockholders' equity, and your balance sheet. We've already done all that, class, so this is just going to be kind of like a refresher. I'm not going to take too long covering it because we've already covered it before. In addition to preparing your financial statements, we are also going to be performing the closing entries, okay? So, the closing entries, okay? Basically what happens is the balances of the accounts reported on the balance sheet are carried forward from year to year. So any of your accounts that you see reflected on your balance sheet, those are your permanent accounts. Those will never be closed unless the business is closed. But if you are just going from year to year in your business, those are known as your permanent accounts. So any balances on any of your accounts on the balance sheet are permanent or real accounts. Okay, this includes your cash, your receivables, your equipment, your accumulated depreciation, your accounts payable, your common stock, retained earnings. All of this, any account that you see on a balance sheet is a permanent account. So what does that mean, miss? Well, that means that those accounts will always stay. You're just going to roll over the balance to the next year. That's all you're doing, rolling over that balance to the next year. Then we have some other accounts that are temporary accounts or nominal accounts, okay? So the balances of the accounts reported on the income statement are not carried forward from year to year. So if you see an account on the income statement, and remember on the income statement we have two types of accounts. We have your revenues and we have your expenses. So those accounts are your temporary accounts, okay? Okay. So these accounts are only reported for one period, 1 year, okay? Temporary accounts are not carried forward because they relate only to one period. And when we talk to one period, it means usually 1 year, okay? Whether it be a fiscal year or a calendar year, depending on what kind of a business, what calendar your business uses, okay? But these accounts need to be closed every end of year, and then we start fresh the following year. Okay, so we accumulate information for a whole year, and then at the end of the year we have to zero out this account and start fresh the following year. Okay, so basically what happens is the closing entries transfer the balances of temporary accounts into your retained earnings account. So basically what we are transferring over to your retained earnings are either your net income or your net loss, and if there was any dividends paid out. Okay, so at the beginning of the next period, all of your temporary accounts should have a zero balance. Okay, so all of your revenue accounts are zeroed, all of your expense accounts are zeroed, all of your dividend accounts are zeroed. Okay, so to achieve this, temporary account balances are transferred to permanent accounts at the end of the accounting period. The journal entries that transfer these balances are called the closing entries. So in Chapter 3, we dealt with adjusting entries. In Chapter 4, we deal with closing entries. The transfer process is called the closing process and is sometimes referred to as closing the books. And this is only done, once again, once a year. We clear out our books and we start fresh the following year. Now, the closing process involves two steps. Step number 1. Revenue and expense account balances are transferred to your retained earnings account. Step number 2. The balance of your dividends account is transferred to the retained earnings account. So those are the accounts that are going to be closed. Revenues, expenses, found on your income statement, and your dividends, okay? So that is what is going to be closed. And that is what we're going to partly cover in this problem. So this problem that we're going to be covering, exercise 413, it says financial statements and closing entries. It says Foxy Investigative Services is an investigative service firm that is owned and operated by Shirley Vickers. On November the 30th, at the end of the fiscal year, and remember it could be a fiscal year or a calendar year, whatever type of year your business is at. So November 30th is the end of their fiscal year. The accountant for Foxy Investigative Services prepared an end of period spreadsheet shown below. Okay, so they're providing you with the adjusted trial balance. These are your balances after adjustments. Okay, so their instructions state that we have to prepare an income statement, a statement of stockholders' equity, and a balance sheet. Okay, so that is the first requirement. That is the first thing that we're going to be doing. Okay, and I'm going to go through this fairly quickly because we've already done this. Okay, so let's start off with our income statement. What goes into our income statement? Our income statement, we have two things. We have our revenues and we have our expenses. Okay, so let's bring in our revenues. Okay, so like I said, I'm not going to spend too much time on this because we've already covered financial statements. This is just going to be practice. So income statement, revenues, and expenses. So let's look at our account and let's locate our revenues. Okay, revenues have a normal balance of a credit. Okay, so let's locate our revenues. We have service fees and we have rent revenue. We have two revenue accounts in this particular case. Okay, no fill, and let's do green. Okay, so we have those two. So I'm going to bring those over to my revenue section. So we have service fees of $675,500. Now, because we have two accounts, we're going to bring them over to our first column. Okay, to our first column, get a total, and then bring the total over to the second column. And then we have rent revenue. And we have rent revenue of $9,000. Oh, these people are on a, my employees, my fellow colleagues are messaging at this hour. Sorry about that. So, okay. So we have service fees of $675,500. And then we have, let me see. And then we have rent revenue of $9,000. So I can get my total revenue. And we're going to add those two together. So I've got total revenue of $684,500. Okay. Next we have our expenses. Okay. So this is fairly simple. Okay. Then we're going to bring in all of our expenses. So we're going to locate the expenses, which are all of these down here. Okay. And we're going to just transfer that over. Okay. So we have salaries expense of $435,000. We have rent expense of $55,000. Okay. We have supplies expense of $11,850. Just make sure you bring in the correct amounts. Depreciation expense, building. We have $10,000, and then we have utilities expense. And if you notice, okay, when you are putting in or bringing in your accounts, they should be sorted in based on the dollar amount. Service fees have a greater dollar amount than rent revenue. It goes first. Your expenses are going to be organized based on the dollar amount, with the exception of miscellaneous expense. Miscellaneous expense, regardless of the dollar amount, it goes last. But the rest of your expenses should be ordered based on dollar amount, from highest to lowest. Okay? So we have utilities expense of $8,800. We have repairs expense $42.50. We have insurance expense of $3,000. Sorry about that, $3,000. And then we have miscellaneous expense of $11,100. Okay, $11,100. Okay. So now we can calculate our total expenses. So we're going to add our total, we're going to add all of our expenses to get our total, okay? And you can do this in a calculator. Because I'm using Excel, I can just put the formula there, okay? So I've got revenues of $684,500. I've got expenses of $539. So what is greater, your revenues or your expenses? In this case, our revenues are greater than our expenses. Remember, if revenues are greater than expenses, we've got net income. If your expenses are greater than your revenues, then you've got a net loss. Okay? So in this case, we've got a net income because we have more revenues than expenses. So I've got net income, and the amount of my net income is going to be your $684,500 minus your $539. That will give you your net income of $145,500. Okay, that is your net income. Okay, let me delete a couple of these. I don't need all of this space. Delete. Okay, so now let me readjust my things down here. My expenses are down here, and then my revenue is over here. There we go. So we've got our revenues and we've got our expenses. Okay, so here we go. Revenues and expenses. So we've got those down. So we've already used up all of these accounts. Okay, so we need to keep record of the accounts that have been used up. So that is done. Income statement, remember two things, revenues and expenses. If your revenues are greater than your expenses, you've got net income. If your expenses are greater than your revenues, you've got a net loss. Pretty simple. Once we've got our income statement down, we're moving down to our statement of stockholders' equity. Okay? So, in our statement of stockholders' equity, we always begin with our balances. Okay? Remember, if it's a brand new business, you're not going to have a balance. But in this case, we've already been in business for a couple of years. So let's put in our balances as of December the 1st, 20Y7. Okay. So the first thing we have is our common stock. Remember, we are bringing in our common stock and our retained earnings into. There's three things that we bring into our statement of stockholders' equity. Our common stock, our retained earnings, and our dividends. Okay, so let me mark those three things in. These three things, these three accounts go into our statement of stockholders' equity. So let's begin with our common stock. We had a balance of $40,000. Okay. And let me put commas. Okay. Retained earnings. Retained earnings had a balance of $70,300. Okay. We get the total of those two. And that gives me $110,300. That is our balance. Next, we're going to bring in the net income or loss generated during the period. Okay. We have net income of $145,500. This net income number is coming from your income statement. Okay. We have net income of $145,500. That increases your retained earnings. So we're going to put that right there. Okay. We're going to get a total for that column. And that's going to give me $145,500. Now, were any dividends paid out? Yes, we had $30,000 payout in dividends. Okay. So then we have our dividends, and we paid out $30,000. So what's going to happen to our retained earnings if we pay out money? If we give money to our stockholders, what happens to our retained earnings? It decreases. So dividends were paid out of $30,000, so those are going to be decreased. Okay, and let's add up that row. Okay, we have $30,000. Okay, now we can get our ending balances. Okay, and we're getting our balances as of November the 30th, 20Y8. Okay, so what we're going to do is we're going to just bring the totals down. Okay, we're going to add our total common stock, 40,000. We're going to add our retained earnings column. That gives me 185,800. And we're going to add our total column. And that's going to give me 225,800. So our balances as of the end of November 30th, 20Y8, we have common stock of 40, retained earnings of 185,800 for total stockholders' equity of 225,800. Okay, that is my total right there, total stockholders' equity. Okay, and these are my total for the categories, each of the categories. We're going to need these amounts, these totals, for the preparation in our balance sheet. Okay, so now let's do our balance sheet. Our balance sheet is the longest. We have all of our assets, liabilities, and stockholders' equity. Okay, so our assets. What are our assets? Assets are anything that we own. It will be this section right here. Okay. Okay. So those are our assets. So I'm going to bring them over to our balance sheet. Okay. So we're going to have our current assets. Remember, these are any assets that you can convert to cash or use up within a year. So I have cash, 27,500. Let me put commas just to keep it consistent. Okay. So I've got cash, accounts receivable of 71,800. Okay. Supplies of 3,550. And prepaid insurance. Prepaid insurance of 750. Okay. Those are my total current assets. The building is property, plant, and equipment. That goes into the next section. So now I can get my total current assets. So we're going to add our current assets. 103,600. Okay. Then we have our next section, which is property, plant, and equipment. Under property, plant, and equipment, we have a building. Okay. We have a building, and the building is 330,500. Okay. And then we have accumulated depreciation for the equipment, for the building, I'm sorry, for the building. The accumulated depreciation for the building is 184,100. Okay. Therefore, my total property, plant, and equipment is going to be building less the accumulated depreciation. It'll be 146,400. Okay. Now I can calculate my total assets. Okay. Your total assets are the sum of your total current assets plus your total property, plant, and equipment. And that gives me $250,000 in total assets. Okay. So the balance sheet, remember you have to break it down into two sections, current assets and property, plant, and equipment. Don't forget to deduct your accumulated depreciation from each of your assets to calculate the book value of the asset. Okay. Next, we have our liabilities. Liabilities are anything that we owe, anything that has the word payable or we have not earned. Sorry about that. So we're going to go ahead and we're going to bring those in, and we have three liabilities. Oh, sorry about that. Right here. Let me see. Insert shapes. Here we go. So these are my three liabilities. Okay. We have accounts payable, salaries payable, and unearned rent. Unearned rent is a liability because we have not provided the service, so we have not earned the money. So it's a liability. We owe a service to our customers. Okay. So let's bring those three liabilities in. We have accounts payable. Well, what kind of liabilities? These are current liabilities. Okay. Remember, current liabilities are anything that you're going to pay within a year. If it's longer than a year, then are long-term liabilities. Okay. So we have current liabilities. We have accounts payable of how much? 16,100. Okay. What else do we have? We have salaries payable. Salaries payable of 6,600. And we have unearned rent. We have unearned rent of 1,500. So we don't have any other liabilities. That's all the liabilities that we have. So we don't have any long-term liabilities. So now we can get our total liabilities. And our total liabilities will be the sum of those three items. $24,200. Okay. Now we have our stockholders' equity. Now, if you see, we've used up all of the accounts on our spreadsheet. All of the accounts have been used. Okay. Revenues and expenses went in our income statement. Okay. And then common stock, retained earnings, and dividend went into our statement of stockholders' equity. And then our assets and our liabilities went into our balance sheet. So now we have the stockholders' equity section. This information is coming from your statement of stockholders' equity that you prepared. Okay, we're going to bring in the totals. Okay, so the first thing that we have is we have common stock. According to our statement of stockholders' equity, common stock is 40,000. Okay. Next, we have our retained earnings. Our retained earnings are 185,800. Okay, that's coming from right here. Our total of retained earnings. Okay. Our total stockholders' equity is the sum of those two, which is basically we calculated up here to be 225,800. Okay. So the sum of common stock and retained earnings is 225,800. All these three numbers are coming from here, from your statement of stockholders' equity. Okay. And then we can calculate our total liabilities. And stockholders' equity. Okay. And to do that, we're going to add our total liabilities plus our total stockholders' equity, and that gives me $250,000. Okay, remember, total assets must equal your total liabilities and stockholders' equities. And I misspelled liabilities, guys. Okay, let me fix it. Liabilities. Total liabilities. There we go. Okay, so total assets need to equal your total liabilities and stockholders' equity, which we do. We are at $250,000. So we've prepared our income statement, our statement of stockholders' equity, and our balance sheet, and we've used up all of the information provided. Okay? So requirement 1 is to prepare an income statement, statement of stockholders' equity, and balance sheet. Okay? Requirement 2, journalize the entries that were required to close the accounts as of November the 30th. No additional common stock was issued during the year ended November the 30th. Okay? So now we need a journal. So I'm going to put the journal down here. Okay? So we have a date, a description, debit, and credit. Okay? And we need a journal right there. Let's just create a journal. Here we go. Okay? So we're doing a closing entries. They're asking us to do the closing entries. And remember, we are closing these accounts. We're closing revenues, expenses, and dividends. So we close revenue and expenses to retain earnings. We close dividends to retain earnings. Okay? So let's get started. And these entries are closing entries. They are done as of the end of the period, which is November the 30th. Okay? So how do we close these accounts? Okay? So the first thing we have to close are our revenue accounts. Revenue accounts have a normal balance of a credit. Okay? So if I want to close it, I have to do the opposite, which is debit the accounts. Okay? Let me show you a T account. Just an example. Let me see. Let me show you how it looks. Okay? So let's say we're looking at service fees. Okay? Service fees. Okay? So service fees has a balance of $675,500 credit. Okay? So this is my balance, $675,500 credit. If I want to zero it out, what do I need to do? I would need, this is the balance, and then I would be closing. Okay? So I would have to debit at $675,000, and then my balance would be 0. Okay? So what did I do? I had a balance of $675,500 credit. You close by doing the opposite. So you would be debiting service fees. My balance would be 0. This account would be closed. Okay? So let's do the entry. Service fees would have to be debited for the $675,500. And we have another account. We have service fees, and then we have rent revenue. Okay? Rent revenue. Rent revenue has a balance of $9,000. So we're going to close it too by debiting it. So we do the opposite of what we have up here. So we have a credit and we want to close them. We need to debit those balances. Okay? So we're going to debit them, and it says that we're going to close them. Okay? To retain earnings. But we're going to wait, because in the first item, they're asking us that we're going to close two things. We're going to close revenues and expenses. So all of our expense accounts have a normal balance of a debit. If we want to close them, then what do we need to do? Correct? We would need to credit these accounts. So expense accounts have a normal balance of a debit. If I want to close them, I need to credit my account. So I'm going to bring in all of my accounts, all of these expense accounts, and I'm going to credit each of them for their balance. Okay? So we have salaries expense. We're going to credit that. How much? $435. Okay. We have rent expense. Rent expense is $55,000. Okay. We have supplies expense. Supplies expense has a debit of 11,850, so that means we're going to credit it 11,850. Okay. We have depreciation expense. My depreciation expense for the building is 10,000. We're going to credit it. Okay. Next we have utilities expense. My utilities expense is 8,800. Okay. Repairs expense. Repairs expense 4,250. So we are zeroing out all of our revenues and our expenses. Insurance expense. Oh, sorry about that. Insurance expense. So my insurance is insurance 3,000. And then we have miscellaneous expense. Miscellaneous expense is 11,100. Okay. And it says that we're going to transfer the difference into our retained earnings. Okay. So let's see what happened. Okay. Okay. So let's look at what is happening here. So all of our revenue accounts got debited. All of our expense accounts got credited. Okay, so let me see what we're doing. Okay, so this is going to be my retained earnings account. Okay, let me zero this out. So it says that we're transferring over all of our information from our temporary accounts into our retained earnings account. So we have revenues, okay, that are being transferred. We're closing them out, so we're going to debit the accounts. Okay, we're going to debit the service fees revenue account, and we're going to debit our rent revenue. And then what would be our offset? Our offset would be our retained earnings account. So if we debit service fees and rent revenue, that means that we would need to credit, okay, retained earnings. The total of these two is 684,500. Okay, so the total of those two, 675,500 plus 9,000, 684,500 would be transferred to my retained earnings. Now for my expenses, my normal balance of my expense accounts are debits. I'm closing them out by crediting them. So the expense accounts are going to be credited. So that means I need to debit my return earnings. Okay, this is for my revenues. Okay, that means I would need to debit my retained earnings for the total of my expenses. And the total of my expenses is 435 plus 55,000 plus 11,850 plus 10,000 plus 8,800 plus 4,250 plus 3,000 plus 11,100. That'll be $539,000. So my total expenses are 539. So I would retained earnings would be debited for 539. These are your expenses that you closed. Okay. So you closed out your expenses of 539 to retain earnings. You closed out your revenues of 684,500. Okay. So the amount that your entry would be need to be done would be for the net of those two. Now, which side is larger, debits or credits? Credits. So that means that I would need to transfer over my balance on my retained earnings would be the 684,500 minus the 539, 1, 2, 3. Okay, I would be transferring over to retained earnings 145,500. Okay, that is the amount that you're transferring to your retained earnings. And why is it on the credit side? because the credit side is larger than the debit. So 684,500 minus 539 gives you a credit of 145,500. That is the amount that is being transferred over. This is basically your net income, guys. That number, 145,500, should be the amount of your net income, okay? So you're transferring your net income to your retained earnings. So I know that my retained earnings need to be credited 145,500. Okay, so retained earnings need to be credited 145,500. Okay. Now, of course, I like to make sure that my debits equal my credits. I am just going to make sure of that before I move on to the next entry. Okay, and yes, they do. Okay, debits equal credits. Okay, so let's recap. What did we do here in the first closing entry? We closed revenues and we closed the expenses to retain earnings. Okay, so we had in revenue, we had 684,500. We transferred the balance into our retained earnings. Revenues has a normal balance of a credit, so we transferred the credit balance to retain earnings. We closed out all of our expense accounts by crediting them. So our expense accounts are being credited. That means that we're transferring our total debits, our total expenses, which have a debit balance, over to our retained earnings. So my expenses are transferred to retained earnings of 539. Okay. So now I know that the net amount that was transferred to my retained earnings was my revenues less my expenses. So my retained earnings increased or got credited by 145,500, which was the amount of my entry. Okay, so I'm transferring my net income into my retained earnings. The next thing that we have to do is close our dividends. Okay, so dividends, let's look at dividends. Dividends have a normal balance of a debit. If I want to close my dividends, then that means I need to credit my dividends. Okay, so dividends need to be credited by $30,000. Dividends need to be credited by $30,000, and we are closing. If you look back at the steps, the balance of the dividends account is transferred to retained earnings. So if dividends is going to be credited, that means that retained earnings is going to be debited those $30,000. Retained earnings gets debited, dividends get credited. At the end of these two closing entries, all of our revenue accounts, expense accounts, and dividend accounts will be zero. And you can start fresh the following year. Okay? So all of our temporary accounts are going to be closed. Okay? So this is the closing entries. Okay? These are closing entries. And these are only done once a year during the closing process. Okay? And remember, it's just very easy. 2 steps. This is the closing process. Close revenues and expenses to retain earnings. Step 1. Close dividends to retain earnings. Step 2. Okay? Okay, so that is it for requirement B. This is the second requirement. Okay? Or requirement 2. They have it labeled as requirement 2. Let me make that correction. Okay. Requirement 3. If retained earnings had instead decreased $46,000 after the closing entries were posted and the dividends remained the same, what would have been the amount of net income or net loss? Okay, so it says if retained earnings had instead decreased. Okay, so if we had a decrease in retained earnings, what would have happened? What does it say? If retained earnings had decreased by 46,000. So here retained earnings had increased initially. They're saying what if it had decreased by 46,000 after the closing entries were posted and the dividends remained the same? What would have been the amount of net income or net loss? Let's do that one over here. Requirement 3. $30,000 decrease is caused by the $30,000. We have a $30,000 dividends, by the $30,000 dividends, and a $16,000 net loss. So first we have to net loss. First we need to figure out why would we have a $46,000 decrease in our retained earnings. So it says if retained earnings had decreased by $46,000 after the closing entries were posted and the dividends remained the same, what would have been the amount of net income or net loss? So if the 46,000 decrease occurred, it is caused by the 30,000 dividends and then a $16,000 net loss. So we have the $46,000 decrease. Okay, $46,000 decrease. And we know $30,000 of that decrease is caused by our dividends. That means that our net loss would have been $6,000. Okay. So what they're asking you here is, what if we hadn't had net income? In this particular example, in step number 1 where we calculated all of this, or based on the information provided, we had net income of $145,500. Okay, that is what we had, $145,500. In scenario 3, it's telling you, you know what? What if retained earnings had instead decreased by $46,000 after the closing entries were posted? So after we posted the closing entries, we had a decrease of $46,000 and dividends stayed the same. So if dividends stayed the same, then I know that I had a $46,000 decrease in my retained earnings caused by $30,000 of a dividends payout. So that means that we had an additional $16,000 decrease due to a net loss. Okay. So it's just a matter of, okay, if our retained earnings decrease, why did it decrease? Well, the first thing we look at is, did we have a dividend payout? Yes. Okay, if we did, then we figure that into the equation. So that means that the rest of the decrease is caused by your net loss for that particular period. You didn't generate enough revenues, so you had a loss, and that is what's causing your retained earnings to decrease. Okay, so it's quite a bit of information. Okay, in this problem, we went over preparing our income statement, our statement of stockholders' equity, our balance sheet, preparing our closing entries, and then analyzing a scenario down here. Okay, a lot of information. Please read over the chapter carefully. Practice your financial statements. You are going to see financial statements on your first test. You need to master how to prepare all of your financial statements. Okay, utilize the 2 attempts provided. Questions or concerns, please reach out to me. There is tutoring at the CLE lab if you need additional tutoring. I encourage students to create study groups amongst themselves. That way you can collaborate with your classmates, help each other out, get to know your classmates. I am all for that. But if you want to reach out to me specifically, you can either stop by during my scheduled office hours, send me a Blackboard message, an email, a pronto message, whatever works for you, and I'll try to get a hold of you as soon as possible so we can schedule something to meet. Okay, that is basically it for this is problem, and I forgot to change this down here. This is problem 4-2A. There we go. Made the correction. Okay, so this is problem 4-2A, financial statements and closing entries. Okay, so I want to wish you all a wonderful rest of your week, and until next time, thank you very much.